It feels like everywhere you turn lately, every financial headline is screaming about potential new tariffs, right? And
Yeah.
and some like big shifts happening in the whole economic landscape.
Yeah, yeah.
And it kind of leaves you wondering, like, what's the smartest way to enjoy your money right now? You know,
Absolutely.
like trying to sift through all that information can be super overwhelming.
It really can. It's a challenge to make those decisions about your financial future when there's so much noise.
That's exactly what we're going to try to tackle today.
Yeah.
We're going to take a deep dive into three really common investment strategies that people talk about a lot: buying the dip, dollar cost averaging, and even just the idea of holding on to cash.
Hmm.
And we're going to break down those strategies based on insights from some of the top finance experts out there. Think of it as your shortcut to understanding what's really going on and getting some ideas you can actually use.
Yeah, we've been looking at a lot of different YouTube videos from finance experts talking about market trends, different investment approaches specifically for 2025, and even some analysis of specific stocks.
One of the first things that jumped out at me was this sense of unease about the economy. Like, a lot of these experts are saying there's a real possibility of a downturn in 2025.
Yeah,
Marco from Whiteboard Finance, he used this phrase, massive reversal, to describe what's happening with the 10-year Treasury yield,
right.
which is falling pretty dramatically while inflation's actually going up.
Yeah.
Now, usually when the 10-year Treasury yield is rising, it's a sign that the economy is doing well.
Mm,
So when it starts falling and inflation is still high,
yeah.
it's like the market is saying, oh, something bigger is happening here.
It's almost as if it's saying something's really off or maybe even breaking under the surface.
Right. And Marco connects this to the idea of trade tensions and market peaks.
Yeah.
He points out that the last trade war started right around the same time that the 10-year yield hit a high point.
Mm,
And now we're seeing those yields falling again,
right.
which he thinks means the market is kind of bracing itself for a recession. And then when you factor in things like the recent announcement of those 25% auto tariffs, it adds another layer of concern.
Right, because it could signal that this downward trend in yields is going to continue.
Marco brought up some really interesting historical data about market corrections.
Huh.
He said that a market correction, which is when the market drops 10% or more from a recent high, only about 56% of those don't end up leading to a recession.
Wow.
So a good chunk of the time, 32%, they do lead to a recession within a year.
Yeah.
And he pointed out that the S&P 500 is already in correction territory, so these auto tariffs could be like a trigger for further economic weakening.
If we look at this from a bigger picture perspective, Joseph Hogue from Let's Talk Money, he brought up another concern, and that's the possibility of the government cutting back on spending, which can have a big impact because the government is a major player in the economy. We're talking about over 10 million jobs and almost a quarter of all economic activity.
Wow.
So even targeted spending cuts could have a ripple effect throughout the entire system.
Absolutely. And he also shared those concerns about tariffs, saying that they're likely to make things uncertain for businesses and lead to higher prices for both companies and consumers. He even mentioned some estimates from the Peterson Institute for International Economics
Oh, wow.
that suggest these tariffs could have a really negative impact on the whole economy and maybe even cause inflation to spike up.
That brings up the whole idea of stagflation, which is when you've got slow economic growth, but prices are still rising, which Marco also kind of hinted at with those falling yields and rising prices.
And then Graham Stephan added to the mix by saying that the chances of a recession in 2025 have actually doubled recently.
Yikes.
And he reminded us that there's usually a lag between when a recession starts and when it's officially announced. It takes over 7 months on average. So we might already be in a recession and not even know it yet.
That's kind of a scary thought.
It is. And what's really concerning is that a lot of sources pointed to actual declines or negative forecasts for GDP, which is that big measure of the total value of goods and services produced in the economy.
Right.
Marco talked about how the Atlanta Fed significantly lowered their estimate for Q1 2025 GDP growth and even dipped into negative territory when they took things like gold prices and trade adjustments into account.
Yeah.
And Graham Stephan mentioned some other negative projections for future GDP growth as well.
It's definitely not looking too rosy right now.
It's not, and it's not just about the big GDP numbers. Marco also pointed to other warning signs, like a drop in consumer confidence, which means people are feeling less confident about the economy,
Right.
and a rise in the price of gold, which often happens when people are looking for safer places to put their money.
It definitely seems like we're heading into some choppy waters in 2025.
So given all this talk about a potential downturn, let's look at some of the strategies people are considering for their investments. The first one we're going to talk about is buying the dip.
Oh, yeah, that's a popular one.
Professor G from Investing Simplified explains it as basically buying stocks after their prices have gone down, hoping to get a bargain.
Right.
Makes sense on the surface, right? When something goes on sale, you want to buy it.
Exactly.
But as Professor G points out, the problem is trying to figure out exactly when the market has hit its lowest point.
Yeah, that's the million-dollar question.
Right. It's like almost impossible to time it perfectly.
And Professor G referenced a study by Nick McJulie that compared buying the dip to dollar cost averaging.
Okay.
And the results were kind of surprising. Historically, buying the dip actually did worse than dollar cost averaging over 70% of the time.
Really?
It seems that trying to wait for that perfect bargain can actually hurt you in the long run because you might miss out on those times when the market is going up.
Yeah, if you're constantly waiting for the bottom, you could end up sitting on the sidelines while the market recovers.
Exactly. And Professor G even shared some data from JP Morgan that shows how much missing those good days in the market can really impact your returns.
Wow.
They found that if you missed just the 10 best days in the market over a 20-year period, your overall return would be cut in half.
That's huge.
It could even mean the difference between making money and losing money.
So trying to time the dip perfectly is kind of risky because you might miss out on those crucial upward swings.
Yeah, you're increasing the chances of missing those really important gains.
Okay, so let's talk about the second strategy, dollar cost averaging, or DCA.
Okay.
Professor G describes it as investing a fixed amount of money at regular intervals no matter what the price is. So whether the market is up or down, you're putting in the same amount consistently.
So you're not trying to guess when to buy, you're just investing on a regular schedule.
That's right. And Professor G highlighted that this takes the pressure off of trying to be a market timer. And he pointed out that historically, DCA has actually performed better than buying the dip over longer periods.
Interesting.
He mentioned studies that looked at data from 1995 to 2018 and even further back from 1975 to 2014. And in both cases, dollar cost averaging came out ahead more often than not.
So consistency wins.
Exactly.
Yeah.
Especially in markets that are unpredictable.
So we've got these two kind of contrasting approaches, but Professor G actually suggests a hybrid approach for navigating 2025.
Okay, so let's break down this hybrid idea.
He suggests that you take your total investment amount, let's say it's $100,000, and divide it up to invest regularly over a set period using dollar cost averaging, like maybe investing $10,000 each month for 10 months.
Okay.
But here's the twist. He also suggests keeping some extra cash on hand ready to invest if there's a really big drop in the market, like if the S&P 500 drops 15% in a week, for example.
So you're basically staying invested consistently, but you're also ready to jump in if there's a significant opportunity.
Yeah, but the key is to decide what a significant drop means to you, and then having the discipline to actually invest when it happens instead of getting scared and doing nothing.
Right. It's like having a plan and sticking to it.
Exactly. And Professor G also talked about how important it is to have a solid financial foundation, especially when things are uncertain.
Right.
He emphasized having an emergency fund to cover unexpected expenses and managing your debt, especially avoiding those high-interest debts.
So basically make sure your finances are in order before you start making any big investment moves.
Exactly. It gives you more flexibility and helps you weather those market storms.
Now let's talk about that third option, just holding on to cash.
Yeah,
When things are uncertain, it's tempting to just keep your money safe in cash.
totally understandable.
Graham Stephan even mentioned that he's seeing a lot of wealthy people doing that right now, holding on to more cash.
Yeah, it makes sense if you're worried about losing money in the market.
Right? But remember Professor G's data about missing those best days in the market. There's a real cost to holding too much cash. If the market recovers quickly, you could miss out on those gains.
That's true. And Joseph Hogue mentioned something called a barbell strategy for managing this risk.
What's that?
He described it as a way to balance things out by focusing on two extremes on one end. You have some higher growth but riskier investments like certain stocks.
Okay.
And on the other end, you have a good chunk of your money in safe and liquid assets like cash or high-quality bonds. So it's not about being moderate. It's about having that safety net of cash, but also having some exposure to potential growth.
So you're ready for different scenarios.
Exactly.
Regardless of which strategy you choose. Our sources also highlighted some specific areas of the market that might be worth looking at in the longer term.
Yeah.
Joseph Hogue said that the technology and growth sectors, especially things like artificial intelligence, automation, and cybersecurity, have a lot of potential for growth, even though there might be some ups and downs in the short term.
He's really bullish on those areas.
He even mentioned some specific companies like Broadcom, which is AVGO in the data center space, CrowdStrike CRWD, and Palo Alto Networks PanW. in cybersecurity and AMD as a potentially undervalued company.
He sees those industries as being driven by powerful long-term trends, like the increasing need for data centers, the growing importance of cybersecurity, and the ongoing advancements in AI and automation.
Our sources also mention looking at value stocks, everything for Money pointed out that there could be opportunities in well-established companies whose stock prices have dropped.
Yeah.
They use Nike as an example. It's a big brand with strong fundamentals that might be poised for a comeback.
Sometimes when a company gets some bad press or there's a lot of negativity around it, it can create a buying opportunity if the underlying business is still strong.
So it's about looking past the immediate noise and focusing on the long-term potential.
Exactly.
Everything. Money also mentioned Alibaba Baba as a potentially inexpensive stock in the e-commerce and cloud computing space with lots of growth potential in China.
Of course, investing in companies in other countries always comes with its own risks.
True, you have to factor in things like the regulatory environment and the overall economic situation in China.
But the potential for growth in China is huge, especially in areas like e-commerce and cloud services.
And lastly, Joseph Hogue mentioned the healthcare sector as a potentially stable area with good earnings expected. He mentioned XLV, which is an exchange-traded fund that tracks healthcare stocks and specific companies like Eli Lilly, LOY, and Pfizer PFEP.
Healthcare tends to be more resilient during economic downturns because people still need healthcare services and products.
Right.
And with positive earnings forecasts for the sector, it could be a good defensive play.
And everything? Money made a really important point. Do your own research.
Absolutely.
Don't just take recommendations at face value. Really understand the companies you're thinking about investing in.
That's crucial. Your investment decisions should be based on what makes sense for your own situation, your risk tolerance, your financial goals, and your understanding of the businesses you're investing in.
So back to our original question. Should you buy the dip dollar cost average or hoard cash? It really seems like there's no right answer for everyone.
It depends on your individual circumstances, your risk tolerance, your financial situation, and your time horizon.
To sum up, there's definitely a lot of economic uncertainty right now. Trying to perfectly time the market is really difficult. Dollar cost averaging offers a more consistent and historically successful approach, and a hybrid strategy might be a good way to balance risk and opportunity.
And while holding onto cash might feel safe, it does come with the risk of missing out on potential gains if the market bounces back.
All of this brings up an important question for you to think about. Given all this talk about market volatility and uncertainty, how much fluctuation in your investments are you truly comfortable with, and how will that guide your decisions, not just in the short term, but in the long term?
Thinking about the long-term implications of your choices is really important.
Absolutely food for thought.
It is.
Well, that's all the time we have for today's deep dive. Thanks for joining us.
Thanks for having me.
We'll see you next time.
See ya.